Hello and welcome to the latest Insider interview. Our guest today is Mike Fox, manager of the Royal London Sustainable Leaders Trust. Mike, thank you very much for coming into the studio.
You're welcome.
You can invest in fossil fuels, but you choose not to. How has that affected performance of your portfolio?
Time horizon's really important for this. So I think if you looked over the last 20 years, it's been a huge benefit to the fund not investing in fossil fuels. In 2022, clearly the war in Ukraine, it wasn't helpful not investing in fossil fuels. This year, interestingly, the oil price remains subdued for all the tensions geopolitically and an economy that's better than expected. Oil remains subdued. So more recently, it's been more neutral. But again, your time horizon when you think of that issue is quite important.
And over these 20 years without oil, where have you generated your returns from that have led to so much outperformance? Can you name a couple of sectors and companies that have really done well for the portfolio?
So the single most important sector to get right as an investor is technology. It's the one sector that really can innovate in a material way. And you can see this in the headlines today. Nvidia, $3 trillion company, Apple, $3 trillion company. These companies were fragments of that 10, 15 years ago. So you have to get technology right. It's a sector that people often misassociate terms with, like bubbles and speculative and so on and so forth, mainly because every decade or two it does have something of that nature. But if you can invest in sensible technology companies, so Sage would be a good example in the UK. If you can invest more globally as well, Microsoft is a great example. These are the companies that are most likely to deliver strong innovation and therefore strong returns.
Technology is an exciting theme. So where are the technology leaders in the UK, and are there ways of profiting from artificial intelligence by owning UK shares?
There are some really great opportunities to invest in artificial intelligence in the UK. The big winners will be the companies that have data sets that AI allows them to use in a more valuable way in reference to their own clients. So we've already talked about RELX, we've already talked about London Stock Exchange. You can add Experian and Sage into that, and you've got 4 large UK companies that are world leaders that will benefit from AI. It's actually quite a clever way of thinking about investing in AI. Nvidia is the big topic of the day. Whether they'll be the winner or loser in 5-10 years' time comes down to technology cycles, which may or may not go in their favour. But the 4 companies I've just mentioned will exist with or without AI, but AI will benefit them if it is proven to do what some people think it can do.
And is that in the price of these companies, do you think, there's potential for AI to help and grow their businesses, or are they still perhaps undervalued relative to the opportunity there?
Our sense is they're still undervalued. So to give you some examples, cloud computing first came along in 2013 when Amazon split out their cloud computing business. So you could see how profitable it was. At that time, Amazon had already performed well, and many people had the mentality that it was too late. But you were very, very early on into a 10-year bull market in this area. It won't be linear, there'll be ups and downs, but our sense is that we are very early on in understanding how AI will benefit broader society and the corporate world, and that a mentality of having missed it is not a good idea at the moment.
You've owned some long-term winners, but are there other areas that are undervalued at the moment that you're putting money into?
Yes, we have. So GSK, or GlaxoSmithKline as it used to be, is one example of that. That's a company that has struggled to develop an innovative pipeline of drugs. But we think the current CEO, who's been in place now for 6 or so years, is starting to turn that around. Pharmaceutical businesses are like that. They do take 10 years to turn around. AstraZeneca was the same before its recent run of success. So there's a good example of it trades on a 10 times PE multiple, which is, for those who follow markets, is cheap. Would be classed as value, but we think if the business can do what it says it's do, in time it will be classed as a growth stock that you can buy cheaply today.
You have about 20% invested overseas. So why do you do that, and where are you finding opportunities?
Yes, we absolutely do use that. We think it's a very powerful way of adding on to core UK exposure some names that you can't get exposure to in the UK. So Visa would be a good example of what we own. Texas Instruments would be an example of a semiconductor company we can own. Microsoft is in there. Even Novo Nordisk, which gives us exposure to obesity drugs, is in there. So the core of the fund will always be the UK, but the ability to invest selectively overseas, we think, is a very useful and additive part of the process.
Given you have this global perspective, and also there are funds from Royal London which deploy the same portfolio strategy but only invest internationally, do you consider the UK market undervalued at the moment?
I consider the UK market misunderstood at the moment. The valuation point depends on where you look. The market looks cheap as a whole because it has a large number of banks and mining companies and oil and gas companies that trade at low valuations. So it's like an index composition issue. If you look at AstraZeneca, if you look at RELX, if you look at London Stock Exchange, there isn't obviously a misvaluation versus global peers. US investors are happy to buy those names, so they don't allow that arbitrage to exist. So I think that the question about the UK really is not whether it's cheap or expensive, it's more where are the attractive parts of it you can invest in that can give you similar type returns as global funds, and they absolutely do exist.
And you've been managing this strategy for 20 years now. So what are the big investment lessons that you've learned along the way?
So my view on investing is that individual investors take too little risk and professional investors take too much risk. And by that I mean individual investors are often put off by the volatility of equities and don't get the benefit of what is a compelling way to invest in the long run. But then professional investors, they're a little bit like people who go out in the snow in 4x4 vehicles. They're more likely to have accidents than people with traditional cars because they have a perception of safety and expertise and knowledge, which isn't always the case. So I do think if you're an individual investor and you've got a long-term horizon, most tend to take too little risk. But for me as a fund manager, over my career, I've probably become more risk averse the longer I've done it.
What's been your best investment decision over that 20-year period?
Cloud computing in 2013.
And how did you access that via the fund?
So that would be a good example when we would use the overseas exposure. So owning Amazon, owning Google, owning Microsoft would be examples of that. Latterly, UK companies benefit from cloud computing because it makes them more productive and more efficient, but that would be a great example. Another one would be in the 2000s was emerging markets and the whole infrastructure boom that went around in China. There was a lot of very productive engineering businesses in the UK market that performed extremely well for a period of time. So I would say emerging markets in the 2000s and cloud computing in the 2013 would be the two big ones.
There's lots to watch in terms of the macroeconomy at the moment, inflation, interest rates. Do you pay attention to those elements when it comes to investing?
For us, we found that taking pronounced economic views over the years has been detrimental to investment performance. So a great example of this is the famous headline from Bloomberg in October 2022, when they said there was a 100% probability of a recession, statistically back-tested in the US in 2023. That was completely wrong, but it tainted so many people's views of how to invest, and many investors missed out on a really great 2023. So I think for us, one lesson of investing is be aware of macro. There's no point not understanding it, but if it becomes the dominant way you're thinking about investing, that can be risky.
You spend a lot of time talking to companies, so what are you learning from them at the moment?
The most interesting thing the companies that we meet say to us is how fast US investors are buying up UK equity. So if you take Compass, for example, their US shareholder register has increased significantly in recent years. US investors are happy with the disclosure, the corporate governance, the rule of law in the UK, and see it as a really attractive place to invest. One CEO said to us that the only investors that seem to be unhappy with UK equity investing are UK investors. When they meet their investors globally, they do not get that same feedback.
And why do you think that is? And why haven't we seen a strong market bounce back in the UK? There has been a recovery, but there hasn't been a very strong one yet?
The market issue is, again, the composition point, that if you've been invested in oil and gas companies, if you've been invested in mining companies, if you're invested in tobacco companies, you're right, you've missed out on these things. But that is a choice. There are plenty of other areas in the UK market that have delivered global equity type returns. So you have to be precise in where you're going to invest. I think ultimately why overseas investors are more optimistic than us. I think if you're a UK-based individual, you've seen multiple prime ministers, multiple governments, you've lived through Brexit, and I think you can get a little bit downbeat about your own circumstances, whereas when you look at the broader context, people who haven't experienced that may look at the UK and see it in a different light.
And finally, the question we ask all of our guests, do you personally invest in your fund?
Absolutely, I do, and I wouldn't recommend someone buy my fund if I wasn't prepared to own it myself.
Mike, thanks very much for coming in.
Thank you.
And that's all we've got time for. You can watch more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.